Today is October 30th and it's 9:35 a.m. in London when we're doing this market update. And we're going to take a look at the markets as we should this time of the day. Uh, let's begin then. We're going to begin with the euro, which has been terribly boring this week. Markets have been quite boring for quite some time, but it feels like it's getting worse. Like this is a weekly chart, and from low to high, this market has been trapped in a range of 48 pip. Normally, that should be what you have in a day, if not more. Like I remember a few years ago, I think I need to load an indicator for that. Like you get like 120 pip per day. Now the average volatility is 50, but just last year it was at 81, and sort of been around 76 for quite some time. But yeah, it's a bit. Actually, this is just from 2015. This is interesting. We only get data from here. If you look back, I started to trade in 2006. That year, volatility was at 108. Increased to about 116, even more. And under the financial crisis, it was about 300 pip per day. And then it sort of settled. If we take a look at this from a monthly perspective, do like a monthly chart and a yearly average. Let's do it monthly because this is not going to work. There we go. So volatility right now is at levels on a monthly basis. On a monthly basis, it moves to 304 pip. When I started trading in 2006, it would give you about 440. Right now, volatility is down to same levels as you know since a while back. 1984, 1985. That's how low volatility is. So, if you wonder, why not much has happened over the last few days, well, volatility is stuck, and volatility tends to cluster. What does that even mean? It means that when you have low volatility, you'll have low volatility. Then something happens, shakes up the system, and you have high volatility, and then you're stuck in a high volatile environment. And I talked about this before. Some of the reasons are, you got, for example, President Trump trying to talk down the dollar. Sometimes he tries to talk down crude oil prices. You have other officials as well trying to intervene. You have central bankers loving it. I guess they do want to have a stable currency. So there's all of these things that are influencing the markets. The good and the bad, well, the bad in the short term is that it's difficult to make money because things actually don't move. Number two is when the things actually start to move because they've been out of place from where they should have been. When the markets finally are allowed to do what they want to do, and everybody sort of agrees, starts to herd, they will quickly push price towards its equilibrium. So that is something to bear in mind. So as I've been saying for quite some time, you just need to be patient. So what's going on here then? Not much. As you know, I was bullish and turned bearish on the 24th. So from the 24th, we had one trade idea. That trade idea was to sell here. And that trade idea was in a bit of profit for a while, back to break even, and then a bit of profit, and now it's moving back up here. And it's getting very, very, very close to being stopped out. Because what I do here is that I lower and lower the trend defining level to give the price less space. The idea if you do like that, usually if the market will go to our advantage, we lock in some profits. Alternatively, like today, we only reduce the risk, and then when we do get it right, for example, we said turn bullish from here, then it makes up for all of the small losses. So today, my outlook remains unchanged. It's the same outlook I had since the 24th of October. The only thing that has changed again is the trend defining level, which was here. It's not here. If we take this out, this level, it's not necessarily going to change things in a major way. We're just going to go back to the same highs that we saw around the ECB rate meeting last week. As for the pound as well, it's ridiculously low volatility. This one I know is a little bit higher. For this week, the market has moved 94 pip or so, which is not a lot. And if you just look at this chart, it's quite clear you have a very strong move. From the low, the market went up with 810 pip. From this low here, the market is up with 1052 pip. And that's a good move. That is a good move. So we haven't had any sort of correction. I think independently of election or not, whatever happens, realistically here, a hedge fund or someone with a lot of money probably would wait for a bit of a pullback at least. Short-term traders, of course, they might still buy here and lift things upwards. But the big guys that tend to move the market, they're not very keen on buying at these levels unless they're forced to. So I still insist that we need to keep a very close eye on 27.89. And if we trade below that level, this thing can come down tumbling quite quickly, because there are people that have been piling in here. They have been going long. And if we trade below support here, there's not any longer going to be a bullish trend. And all these people that bought up here are going to be under pressure to get out. At the same time, though, as I just said, bullish traders, they might still be buying here, short-term ones, sorry. And, you know, it's always just a mathematical issue most of the time. Like, you buy here if you could yesterday. Say you didn't buy at the highs. Rather you bought here. You know, you risk 40 pip to potentially make 185 pip. Is a no-brainer, as we say in England. Dollar yen remains bullish. The idea has been to buy here over the last few weeks. We turned bullish on the 15th when we got stopped out, because we were bearish on from here, as you might remember. It went okay, then it went up, almost got stopped up, but then the whole thing moved down, and then the idea was to sell here somewhere, but that did not work out. So then I just been to buy here, and the first few ideas worked out okay. We reached the first target. Now if we go down to 108.70, I still think people are going to buy. In fact, we're starting to see some stabilization here already. This is definitely worthwhile to keep an eye on, because stock markets overall are really bullish. And you can see it on the daily that you have an inverse head and shoulders. You have a right shoulder, you have yourself a left shoulder, and you have a head, and then you have the break here where it is bullish. So you really want to keep an eye on that. Now, what can cause this to move? What can cause all these markets to move? Most likely today, it's all about the Fed rate meeting. And what's interesting is that the central bank is anticipated to cut rates. However, according to the Federal Reserve themselves, they don't anticipate a rate cut. What's also quite interesting is that the market itself, if we take a look at the CME FedWatch tool, let me show you. So the markets themselves are projecting a rate cut. So the likelihood of leaving interest rates unchanged at 175 to 200 range, likelihood of that happening is just 3.8. The Federal Reserve knows this, and they had ample of opportunity to tell the market, guys, you're wrong. Obviously, they have not done so, so they're going to cut here. Otherwise, it would be a big surprise, and they would be heavily criticized. Now, beyond that cut, so let's take a look at June of next year. You can see that we're going to cut, so we're going to be here, right? The likelihood of a further cut is going to be at about 49%. That we might be at 125 to 150 by June, on that June 10th, which is that meeting. So we're here right now. Sorry, we're here. We're gonna go down to this level today, and then it's all about this. So in fact, actually, if we're gonna be here. So there's gonna be a 38% likelihood that we go down one more step, and 11.5 that we're gonna go down further one more step. So if we add these up, it'll be 49, 49, 50%. But that's far away, June. So the Fed can see this as well. So what can they say? They can probably say, we're gonna take it easy. We're gonna take a pause in the rate cuts. And remember, this is what the Federal Reserve have been telling us as well. This is just a mid-cycle rate cuts, something along with the lines of that, which effectively means we're not going to start to cut rates because they don't think that the world economy is going to collapse, or their economy, the US economy. Rather, they think it's a slowdown because of trade wars. and the fact that interest rates were very high to begin with. So that could potentially be what can cause the dollar yen to go up. It can be what we call a hawkish cut. So what's a hawkish cut? A hawkish cut is when they say they cut, but then they say we're not gonna cut more, we're gonna take a break. Some of this is priced into the market, right? Because they don't anticipate anything until June. But you know, the market likes to exaggerate. Yeah, it goes from everybody betting on a rate cut and for one period, and then I mean, to give you an idea, the market has been anticipating rate increases. Let me see if you can find it here. See if I can change this. So this is the the federal funds effective funds rate. So I remember very well when the market collapsed, they cut interest rates, and then immediately after, like this is years, like 2009. I think probably by 2010, 2011, around this period, people were 100% convinced they were going to raise interest rates. But and then it continued, it continued, it continued. This whole era here was the Fed is going to raise interest rates. The Eurozone is not going to do, so you should buy some dollars. And people were like very, very aggressively bullish until it finally happened. So this little thing here that shows you how the market is positioned doesn't necessarily, it predicts things in the short term, but it has to do with the fact that the Fed as well looks at this one. It doesn't necessarily predict what's going to happen in the long run. So people can go now from anticipating a rate cut to anticipating no rate cuts, and then they can again anticipate more rate cuts. So it sort of swings a bit like anything else. So that could be something to keep an eye on, or that should definitely be something to keep an eye on. So if you have what we call a hawkish cut that can lift things upwards, it could also be what's going to cause the pound dollar to go down. It could also be what's going to affect things negatively, unfortunately. My personal view is that they're probably going to do a bit of what we call, they're not going to be as dovish as people project. Okay, so this is the price of crude oil. So crude oil moved down as I wanted it to do. Unfortunately, did not go all the way down I wanted it to go to. It went only to a 50% correction. I think I'm going to lift this a bit now. So we're going to lift the buy zone a tiny bit. So we're going to move this up a bit. And I think stop-wise, we can reduce this a tiny bit, but not by much. So if we go down to 54.86, then I think some people might buy here. Looking at this psychologically, 54 sort of sticks out. That would be an amazing entry. And I'm gonna leave the stop where it was. And then I think we'll attack the high again. As for gold prices, I turned neutral here, even though you do have a bit of a bullish bias. You can see price bottomed out on October 1st, then on October 13th, higher low, and we sort of respected this level. So I think we can swing back up to the breakup point here. But looking at this right now, it's just trading sideways here. If the Federal Reserve today decide not to, or to do what I said, take a pause in the rate hike, then that could be an indication, or that could actually cause the gold prices to go down a bit. But it's probably better to let them have their event, and then let's see how the dust settles. If you look at the S&P 500, which is down here, the market was capped by this median line of this nice channel. This channel did a good job indicating the low down here. Unfortunately for myself, I didn't draw these until after the fact. This channel has been okay. It's been around for some time. It's not the best channel because it doesn't have enough touch points, but so far it projected that, or did that good, sort of cap price here. And I think if we go down, then we're probably gonna go up again. And this as well, if we just hide everything, this is a different pattern altogether. You can put a line like that, and then you can put a trend line from here to here, and you get what we call a descending triangle. And the descending triangle has this target. There's a break happened here. So this is your target of that descending triangle. What's quite interesting is that this descending triangle, you have something similar in the Nasdaq 100, you have it in the Swedish stock market, you have it in the, I mean, the Italian stock market had a nice little break. You got it in EURUSD 50, not the ascending necessarily, but definitely a double top range breakout. Had it on the Taiwanese stock market. You had it on many different markets. And what's quite interesting, and even the China A50 is in some sort of triangle. So they're all sort of telling us that, you know, the markets want to head higher. And you got the QE, you got the expansion of the balance sheet of the Fed. All of this is in causing this to go up. Now, it was quite interesting. And you got financial Twitter. You remember the yield curve? Remember all those guys that talked about it so much every day, and they take it seriously. They go into fights about the yield curve over Twitter, which I find hilarious. I don't understand how people have time to spend so much time on Twitter to debate things like this, because nothing is absolute. And maybe that yield curve will come back and will cause a bit of will cause a slowdown, and I'm sure it will predict the next recession probably, and that's all the QE messes things up. But it's quite interesting to see that even myself, I've been bearish. I've definitely been bearish. But when the charts tell you something like this has changed, we kind of need to go with flow. And it's all about the risk-reward ratio at the end. For example, the Nasdaq, I like that the most. You have a descending triangle here as well. So if we do have a little bit of a pullback, there's nothing wrong trying things out. It's going to be interesting to see, though, how financial Twitter will react on this. Financial Twitter, again, has been very, very bearish. Some of the people continue to be bearish. Some people are not bearish anymore, they're bullish, which is a bit of a warning sign. It's a bit of a contrarian signal. But again, we have all of these things happening. And every time one put a trade on, it's all about the risk-reward ratio. So I risk about 1%, sometimes 1.5%. So if the idea doesn't work, let's use this as an example. So if I buy down here in the Nasdaq 100, stop loss will probably go down here somewhere. I'll probably tighten this up a bit like that, and then we'll do like that. So if I risk 1%, I'll make full. If I really like the idea, we can go a bit more heavy. So for the sake of it, let's put 2% risk. This plus out, I make 8. If you put your money in the bank, you probably need to wait 8 years, or if not 10 years, to get an 8% return. So that all sort of says that this is still worthwhile, because we always need to compare it. We don't always have to compare with the benchmark, but it's definitely good to compare with the benchmark. Okay, let's see if you guys have any questions. And we have True Invention in the chat box today. Good morning to you, sir. Thanks for joining. And we have Stefan. He asked, what do I think about palladium? Is it too late to join the party, go long? And True Invention says the market is very slow. And we have Kara Kamrat saying, hi, Alex. So what about palladium? Let's take a look at palladium. Okay, so this is palladium. Palladium. I remember this one. Let's take a look at it from a big picture perspective. Oh, this is an impressive rally here. I'm gonna do a little test here, actually. I'm not sure if I can do it. So this is quite interesting. This is from 1998. So at an amazing, you had a high here at one point. Obviously, you have had inflation, 10 years of inflation. So this is a new high. But the question is it as high on a relative basis compared with what palladium was in the year 2000? So let's find the US CPI. Yes, this one. So inflation from 1999 is up with 52%. So if you whatever you had in dollars that year, compare with now, has lost 52% of its value. Or you need to add 52%. So if you had $100 to buy what you needed, what you need to eat for the whole week, you need to buy the same sort of goods, you need to pay $152 today. So let's take palladium divided over consumer price index. Let's see if that works. So this is palladium versus consumer price index. So you can see here that compared with the prior high, the market is up with 12%. So if it would have been down here, I could have told you target the prior high. The only thing now, they're actually above the prior high, so we can't necessarily use this, but we can from a historical perspective say it's quite expensive. The thing is the palladium I remember, so palladium, as we know, catalytic reactions in cars, right? So there's probably some short-term fundamental story driving this that you want to figure out. Now let's make it less complicated. Let's go back to what we know. So this is some sort of an ascending triangle as well, which is like that. And there's two targets, this one based on the middle, which is a 262% move. And then you have the, from the very base here, which is a $336 move. So you have these two targets, which is projecting the move to the upside. So we still have a bit more to go. And the problem here is, if we would just trade on the back of this, you would wait for a correction back down. But probably by that time, it's not going to be worthwhile. What you could potentially do is that you just focus on the very, very short-term charts. So this will be your 4-hour chart. So here you have very nice and well-defined low down here. We can also just skip to the 1 hour. So on the 1 hour, you have what looks the beginning of a weak head and shoulders, which goes like that with a right and left and a head shoulder. The question is if this is going to hold. I wouldn't be betting on that, by the way. We can definitely say this though. This is an important low. We can definitely say that. And we can take fib from the very low to the very high. Gives you these levels. Again, it looks to me that it wants to maybe overshoot. Not 100% sure about that, but it looks to me that it wants to overshoot. Maybe go down to 1766. And then maybe from here or here, try to build a base to attack that high again. And eventually, maybe we reach that first target at 1881. So that's how I would deal with this. Okay, so we're gonna wrap things up. Guys, thanks so much for watching. Don't forget to click here and like the video. This will be much appreciated. That helps to spread the word. As well, if you're on forums, if you're on Twitter or things like that, then it's awesome. It would be great. You can share directly, but what would be even better is actually to share this page, which goes to Investing Cube, because that's really, really important. Thank you so much, Stefan. I'll tell that to my son. Not sure he agrees. I'm just kidding. Guys, thanks so much for joining me. I hope you're having a great day. Be careful with the Fed rate meeting this evening. It's going to be a lot of choppiness. And unfortunately, you have more choppiness on Friday as well with the NFP and the ISM. After that, hopefully comes down a bit and you have some decent trends. But what's really good, I know I like to talk a lot about what happened in the past, but what used to happen in the past, that you would have these events, have the shock to the system. The Fed does this, the Fed does that, the NFP does this, or so on. And then what would happen is that you will have a trend. You will have a trend for about 2 weeks. So nothing else would bother it. And then new month, new shock, and then you have a new trend. Now, unfortunately, it's a little bit quieter. And yeah, so what's the number one tip here? Just stay safe. Just stay safe. I don't want to brag, but I'm going to brag a little bit. So I'm going to show you my results. So these results don't necessarily have to be replicated in the future. Unfortunately, systems go and come. I always have been using some sort of trend following system, but the system I was using in 2014 and 15 definitely looks different to the one I used in 2018 and 17, but the concepts were pretty much the same. So this is my returns on my own trading on my own personal account, and it's the return per year. So this is 2014. In 2014 I did 34%, and the S&P 500 did 14%. In 2015 this increased to 59. S&P had only increased with 1%. In 2016 I had a bad year, so I was up with 24%, and on that very year the S&P 500 would have beaten me. So someone that actually bought in the beginning of 2014, by 2016 they would have actually catched up with me. However, in 2016-17 I had a crazy year, a lot because of cryptos, and the account was up with about 178% from beginning of 2014. Same time here, the S&P 500 only was at 57. In 2018, I had a 39% return last year, which bumped up this number to 288% return. At this time, as I said in the beginning of the year, if I had stopped trading, it would take people that trade the S&P about 10 years to catch up with me, because the average return in the S&P is like 9% or so. So if these guys with a 65% return, they would need to wait for 9% return, 9% return, 9% return, 9% return, 9% return for about 10 years to catch up with my 288. This year I'm down actually with 22%, and I'm here. The gap has closed, and also the stock markets are up with about 20% this year. So the gap has closed a bit. However, though, if I just stop trading today, again, there's going to be a good few years before these guys catch up with me. So how can I survive? Because these guys, these losses, and here as well, this year I lost about 22%. They're all part of what we're doing here. They're all part of what we're doing here. And the thing here is that the only way that actually has worked is because on average, I never risk more than 1.5% per trade. That's sort of my limit. Now, because I'm struggling a bit with my strategy this year, I'm risking 0.5%, 75 basis points, and so on and so on. So the number one key here to survival, don't trade with too much risk. If you start to risk more than 1.5% of your account, you can double your account, but you can also end up in the statistics of those guys. You know, as you can see with all European brokers now at the bottom, it says 69% of people lose money, and you can easily end up just being one of those guys in those statistics. Now the other thing is then, well, if I risk 1.5% on my £2,000 account, then let me see here. There's $30. So some people say, I'm not gonna risk just $30 to make $30. I'm not gonna do that. I'm too cool for that. That's most people say that. So they don't want to risk that money because it's not worth it. Well, do it like, you look at it like this. Trade with low risk. Do that for a year. And then the second year, if it's going good, try to get a bigger account. Not by borrowing money you can't afford to borrow, but see if you can save more money or put more into it somehow, get another job or something like that. I'm not really sure. So you work with a bigger pot. In my case, 1.5% is multiples of 30. And that's how you need to look at it. And if this grows and grows, eventually, 1.5% is going to be a lot of money. And that's how you can look at it. And this is also why I keep on doing this, even though it's silly hard many times and silly frustrating. The reason why I do this is that if you get it right, you'll literally be ahead years. Let me give you another example, if I can find them, and then we're gonna finish. It's a company called Dunn Capital Returns. I showed this many times to you guys, and this is from August 2009. So to give you an idea, this is a trend following company, and they've been around since October 1974, and they have crazy declines: 30% loss, 27% loss, 28% loss, 63% loss. Imagine here, from 2003, it looks like, all the way into 2008, they had a drawdown, and then from 2002 until about 2013. Is it really that long? Yeah, like 10 years, they're pretty much at the same level. So it's not easy. However, look at these guys. If you would have started with 1,000 in 1974, 1,000, which is something a lot of can invest nowadays, that would have grown to 1.2 million. Doing the same thing, just putting 1,000 and put that in the S&P 500 total return index, then that would give a return of 170,000. So you can see here how trading will beat the stock markets by a multiple of 7 times the return. So what's the trick? Risk small, don't go all crazy, get your things together. When you have that, you can add more to your account somehow. Don't go and borrow from friends and family that you can't, and then you lose the money and you can't pay back, and you just have no friends or family left. Never do that. Just figure things out. And some people, if they trade very good for 3 years, 2 years, they even get capital from outside, or they go and work for people that have a lot of money. And again, if you're managing $10 million, to give you an idea, what's 1% of $10 million? That's 150,000 on one trade. Okay, guys, I hope this was a bit inspiring in these times where it's a little bit boring in the markets. And yeah, guys, thank you, and I'll see you guys tomorrow. Cheers, and bye-bye.